The CNBC App. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC App today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tattlebaum, who is back from Geneva. These are your headlines. The U.S China trade truce sparks a global market rally, with miners and technology stocks leading gains in Europe. Whilst stateside, the Magnificent Seven adds more than, wait for it, $800 billion in market cap.
President Trump says he will force European countries to pay higher prices for pharmaceuticals, vowing to punish countries that refuse to adjust drug costs to match those in the United States.
And President Trump will touch down in Riyadh this hour, kicking off the first foreign trip of his second term and looking to secure major deals in the region.
Open question to you all. How are you? Because my goodness me, I'd imagine some of you have got a mighty hangover, not because you were drinking in those Wall Street or the City of London bars on a Monday, but because what a roller coaster. Your emotions must be full, especially if you were short coming into yesterday as well. And you're back from Geneva.
Yeah.
That was exciting, wasn't it?
Oh, it certainly was.
Karen and I were sitting here as the flashes came, and we'd heard the platitudes beforehand from Besant. Oh, significant progress, really getting on well. But we hear that kind of nonsense all the time from people in negotiations. But then the meat on the bones just got bigger and bigger, and it turned it from a skeleton into a full longhorn heifer. It was amazing. There was a lot of detail that nobody expected.
I think that's exactly it. It was so much bigger than the market had been expecting. I mean, President Trump on Friday, when he posted on Truth Social that 80% was going to be the right level, sounded like the right level on tariffs, that in itself was seen as a big change. And we got so much more than that. So I think it's no surprise the markets reacted as they did. The real test, I think, will be how markets evolve over the coming weeks.
Yeah, we got some ideas on that one as well.
The report suggests a lot of companies were reacting quickly as well. So they'd had an embargo to deal with absolutely no movement of goods across from the two countries. So lifting of that because of the tariff reduction meant that some were quickly racing now against time with another 90-day window. And already the feedback is not everybody's convinced the 90 days will even hold from here. So there's that element of still doubt for some big companies trying to move more product and restock just in case. But that said, we say at what cost? Because the costs are still much higher than what they were previously. So that is starting to filter through for some seasonality effects. Back to school later this year, holiday season, the high prices might start to come into force on the shelves by those key times.
The only thing I would disagree with yesterday and it was Jameson Greer's comment when he was lambasting one poor reporter who said, there's some problems on the back of it. He goes, no, the consumer was holding up, the retail sales were holding up. I was like, well, I'm sorry, Mr. Greer, but the fact of the matter is that's because people, as Karen was pointing out there, were forward buying because they were terrified of the tariffs to come. But there's a lot of detail to fit in. We've got a lot of time to talk about this one as well, and you're going to talk about the markets.
That's right. Global stock markets did rally yesterday after the U.S. and China agreed to slash trade tariffs for at least 90 days. Under the deal agreed in Geneva, the duties the countries charge will be cut by 115 percentage points. U.S. President Donald Trump said the deal offered opportunities to America.
China will also suspend and remove all of its non-monetary barriers. They've agreed to do that. Well, they're very numerous. But again, to me, the biggest thing that came out of that meeting is they've agreed. Now we have to get it papered, but they've agreed to open up China. It's going to be great for everybody.
Well, let's take a look at the mighty US markets. They certainly are on the move yesterday. In terms of the size of the gains, you could see it right across the board and a very large percentage step up for the likes of the Dow, 2.8%. A big moving stock, Goldman Sachs for the Dow. Constituents on the S&P 500 and the NASDAQ, while a huge relief rally in Apple. That was the top moving stock for those two major indices. And you could see the climb, 3.25% for the S&P and more than that on the NASDAQ, reflecting the outsized gain in those FANG Plus stocks. It we mentioned in the headlines the 800 billion that we saw in market cap rally. So the US tech names, let's take a look at some of those big tech titans. And don't forget, it's been really hands-off for this area of the market as investors have been diversifying elsewhere, concerned about the valuations in some of these names. And don't forget, some of them are linked to consumers, linked to advertising. The likes of Meta has been one of them. You can see in terms of the gains here, Microsoft, a very strong rally, 2.4%, but really eclipsed by the big chip company Nvidia, more than 5% to the upside. That relief rally in Apple to the 6%, and even Tesla, which has very much lost momentum in recent weeks, is also on the front foot, as you can see on the back of that trading session. To the dollar, it was a bright moment for the dollar. Very quickly, we saw dollar trades come in. So in contrast to the losses we're seeing against various pairs and crosses for weeks, dollar was king again, at least in yesterday's session. So this morning in the wrap-up, you can see euro dollar trying to claw back a little bit of territory, 2/10 positive along with sterling. So not an even trade again where it's just dollar is king. That is not transpiring again for a second day. Dollar slipping versus the Japanese yen as well, and also against the Swissy. So interesting to see that flip side of that trade today. To WTI, Brent and gold. Again, fast-moving pieces on the reassessment of what the macro could look like because of this retreat on reciprocal tariffs. So oil had a bid, and you can see this morning it is giving back some of that territory, even as we talk about relations in the Middle East with a big tour from Donald Trump. What could that yield for the geopolitical premium in oil prices? So that is one to watch today. But gold prices, interesting to see a fairly large pullback. I think we're down roughly about 3% intraday yesterday on the bullion price. This has been the go-to safety trade for many weeks. So yesterday pulled back, but today recapturing about 0.6%, Juliana.
Trump also hailed the U.S.'s relationship with China and hinted at talks with President Xi Jinping.
Talks in Geneva were very friendly. The relationship is very good. We're not looking to hurt China. China was being hurt very badly. They were closing up factories. They were having a lot of unrest. And they were very happy to be able to do something with us. And the relationship is very, very good. I'll speak to President Xi maybe at the end of the week.
U.S. Treasury Secretary Scott Bessent told CNBC it was crucial. I think I just stole your read. It was crucial to have an even deal.
One of the goals here is to open China for American businesses in a fair way. We want American businesses to be able to sell into China, and part of the goal is bringing down these unfair non-tariff trade barriers, and that's what we will be focusing on. We do not want a generalized decoupling from China, but what we do want is a decoupling for strategic necessities, which we were unable to obtain during COVID, and we realized that efficient supply chains were not resilient supply chains.
Well, the brokers have been very busy. I've got the latest David Kostin note out here from Goldman Sachs, which has cut its 12-month recession probability to 35%, down from 45%. The lender also trimmed its expectations for rate cuts from the Federal Reserve, now expecting just one cut this year, down from 3 previously. Karen, Juliana, I, as a student of markets and a sometime participant in markets, I believe it's actually a really simple beast at times. And I think it was a very simple beast yesterday. The fact of the matter is, people had on, and I'll use Bessent's words here, had on embargo scenario between the two most important economies in the world. That's a disaster. It had on recession scenario for the global economy as well. And what it did yesterday, very clearly, is it said, OK, we don't believe those two factors are now our central case. Now, there may still be risks, as Goldman's is pointing out. So if you take off the embargo scenario, you take off the worst trade excesses scenario, and you take off the recession. Now, and as I read a couple of commentators actually saying, this is now a growth shock scenario. And the market thinks it can handle a growth shock scenario, as opposed to, oh my goodness me, we have a recession, we have a trade embargo, we have trade wars, that we just don't know how to handle that as well. And I think that's pretty much what happened yesterday. They took the worst 2 or 3 scenarios off the table and then said, OK, I think we can handle this.
It gets more complex from here, though, doesn't it? Because we're talking about this 90-day window now to try and come up with further negotiations with the Chinese. economies. And if you don't get a breakthrough, what happens to some of that appetite that's quickly gone more positive from here? What does it also do to the central bank? And we've heard through the analysis that likely that first rate cut has been pushed out to September. So a bigger hold here for the central bank before there's more accommodation that is provided through lower rates. So I think it does get dicier. And the distortions when we're talking about some of the higher prices coming into the mix for the US economy, but we're also talking about companies trying to break ground on new manufacturing in the United States. I was looking at one called Shark Ninja, which we think we all know through the air fryer story. They're talking about exactly. They're bringing some of their production lines back to the United States in 2026 is likely. So some of that breaking ground might also be positive for the US economy. As we know, when you build out, typically that is positive, even more positive than what infrastructure would do over a longer period of time. So the point is, I think it's going to be very complex on what is going to be a growth driver, what's going to be almost a brake on growth, what's going to be driving up prices, what's going to be lowering them.
Well, I'd push back against the notion that yesterday we saw investors come into the market because they're significantly more positive in terms of their outlook for the U.S. economy, in terms of their outlook for the stock market. I think there was actually, to Steve, your first point this morning, a lot of short covering yesterday. We still have a lot of major institutional funds who've been short the market, and yesterday we just simply got the worst case scenario removed, taken off the table. But it doesn't suggest that from here we're going to see further gains or that we're not going to see more short positioning, because you look at where things stand right now, and Karen, you raised this yesterday immediately after we got the statement from the Chinese and the Americans. This isn't necessarily that positive. We're still looking at tariffs that are going to be absorbed to some degree by U.S. consumers. These are still taxes on U.S. consumers. So that is a net negative. It doesn't leave the U.S. in a better position.
And it's lovely watching the robustness of the Chinese foreign ministry back on form this morning. They were quite calm and conciliatory yesterday, but they were saying on U.S. tariffs, U.S. ignores China's goodwill on the fentanyl tariffs as well. So just a little bit of a stick in a bottle. But there's a couple.
Actually true, because Scott Bessent actually talked up the Chinese contribution to fentanil a lot.
And said they brought a senior executive along, or a senior administrator along, who's in charge of that drug policy in it. But there's an easy 20% there for a start. If the Chinese do enough on the fentanyl front to make peace with the Americans on that, and actually on the flow of product to the United States, and there's another 20% off the table like that. So that's a really positive thing potentially.
Which I had actually seen some analysts talk about. If they do end up getting into a situation where they can take that 20% off the table, then the U.S. could revert back to the 34% that was touted on April 2nd as a way to say, hey, we're still going to be harsh with you, but actually in terms of the net impact on business, it's not that severe if they take off the 20% for fentanyl.
I wanted to pick up on your point earlier about positioning, because it does work in reverse as well, because the positioning has been on defensives, it's been on gold, real diversification strategy. And we did see in the trade yesterday, some of those trades actually came off. And you wonder how lasting that could be, whether it's just an early, repositioning, let's go after some of the beaten up areas of the market, or whether that is something that is also a danger for portfolios now. If we get more good news, what happens to, say, gold, where everybody's been positioned that this is a great place to hide out? What happens to defense stocks in Europe? Is that still good short term, or are you going to see that little bit of a wobble there? So I thought that was really fascinating to see the flip side of the trade, where money was quickly being pulled from.
I think that your point about the defense names was interesting. Yesterday, Hensel was the worst performer in the market, down almost 12%. And you have to wonder whether that is a fundamental rethink of how much urgency there will be in Europe. If it looks like Trump is softening his geopolitical stance more broadly, are the Europeans going to feel less of an impetus to spend more as quickly as they were before, if it looks like actually things aren't going to become as bad?
No, I mean, we're now moving on to the Russia-Ukraine side of things as well. And look, nobody doubts that the Russians are the primary threat to Western European security. I mean, there's a lot of other threats out there. We can talk about cyber, we can talk about geostrategic positioning of China, but there's no doubt about it. Russia's the threat as well. And given what we've heard from Putin and Peskov and others so far, the threat is clear and present, that actually he still wants to leave a very weak Ukraine and wants a weaker NATO as well. So I doubt actually that defensive or the defense stock trade, I don't think that's going anywhere for a long time. I think it's just about positioning. And funny enough, just looking at the Frankfurt opening calls this morning, I noticed that some of the defence stocks are on the front foot in the early pre-trade.
Well, another sector we're watching in addition to defense is the pharma sector. Shares of U.S. pharma companies actually rebounded yesterday after an initial sell-off triggered by U.S. President Donald Trump's executive order to cut prescription drug prices. It gives drug makers price targets in the next 30 days and threatens further action if companies don't make significant progress.
Coming up on the show, President Trump is scheduled to touch down in Riyadh this hour. We'll look ahead to what we can expect from his visit. Plus, SoftBank earnings are set to cross the wires. Arjun will join us to break down those numbers. And as China and the US agree a 90-day pause on elevated tariffs, we'll get a read on the e-commerce industry with the CEO of VTEX.
Welcome back to Squawk Box Europe. Blue chip firms are starting to tap private credit more and more for financing, opening the doors to a market that could be worth as much as $22 trillion to the sector. That's according to Barclays, which says capturing even 1 to 2% of that net growth could lead to hundreds of billions in deployment opportunities for private capital over the next 10 years. Juan Delgado Moreira, the co-CEO of Hamilton Lane, joins us now. Juan, great to have you on the program. Let me just kick off with the latest story of the day, the U.S. China come down yesterday. I'm curious what this means for private markets. We've been talking all about the action in public markets, but give us a sense of what it means for your world.
Sure. I think we have a trade truce, not a tariff deal, which I think is important, and we kind of walk back from the ledge. But what it means for private markets is that you've defined a range of outcomes. So we operate in a longer time frame, we have longer dated capital, and what's happening in the market is that nobody could tell what the bottom was or what the worst possible case. So I don't think the worst is over, but I think we've discovered what the worst can look like. And that gives you really a range for pricing and a range for more activity. No longer the case of wait on the sidelines, but now you know the framework.
And what is your expectation for activity in the coming months? I mean, clearly, given the volatility in public markets, one of the key exit routes for private equity has been closed, i.e. the IPO market. We've in turn seen a major uptick in secondaries. What is the pipeline looking like for you in terms of exits?
I think you hit it on the head in the sense that there's a range of activities, it's a range of sectors, and it differs, right? So the buyout piece, the equity financing piece, has been waiting a little bit on the sidelines. And there's been less activity than we would have forecasted because of the volatility and the macro, which I think is being addressed with the changes that we heard yesterday. So we expect more activity on the equity side. Credit has been very active, as you led into the piece, and we'll continue to do that. And secondaries has been exactly even just red hot. We can go back to that.
Red hot. Okay, that's interesting. The secondaries have been red hot. What are you seeing in terms of pricing, though, in secondaries?
Secondaries are red hot because it's really the best instrument that private markets has to participate in a high volatility environment, potential distressed sellers, high volume of selling versus buying interest. All of that is really going to play to buyers. It's a buyer's market. This is not a new market. This has been growing steadily, still relatively small. It's under 2-3% of the whole primaries market. And it's been the right tool, tried and tested in scale and size. And that's why you've been seeing them more active and capturing the pricing opportunity.
Well, in terms of the pricing of assets, you said it is a buyer's market,
Yep.
and yet you also mentioned in the sentence before that it is a highly volatile market. I wonder how quick the pricing of assets in the private sector is to respond to that volatility, given the fact that it's not a stock market. We don't have
Correct.
to see immediate move by move.
Right.
So is the pricing and the realization from the sellers a slower process, a more difficult process for them to adapt to the new environment? Or actually, is it better that they hold off through these periods of volatility and wait for things to calm down?
A lot to unpack on the question, if
Yes,
I may.
of course.
So I'd say the first part is the market price is off of a combination of the latest NAV that is known,
Yeah.
plus all the information that you're supposed to have and the advantage that we at Hamilton Lane as private market practitioners do have. So it's not a public market, it's not a transparent market. But you are obviously reacting to the market daily. And in fact, you have a closing period of time where you can have cash flows and activity. And so it's a good market from the point of view of having a willing seller, a willing buyer, and striking a good price that is current. So that's on the technology piece of that. In terms of the cycle and the volatility, it's a market where the pricing can track the cycle. You can see deals now struck at 92 cents on the dollar. Deals can come back up to par. So we can show you the data that shows you the evolution of that. Should we hold? Should we sell? Part of the other question.
Well, I've never seen an NAV yet on either listed or unlisted that it was below the market valuation. The NAVs always see it to be like, for instance, in the REITs or in the property sector as well. Yeah, they're very, very slow to come down to the reality of the current market, aren't they?
Not as much. I mean, this entire private markets industry is closer to fair value than we get credit for, frankly. And Hamilton Lane has been, we think, pioneer and bringing more data, more transparency, and welcoming that question, that line of questioning, and that approach. But again, remember that the transaction itself has to strike a price. And this, we're dealing with a very sophisticated institutional level of sellers and buyers. So no one is in distress from a point of view of absolute fire sale situation, and therefore these are bargains that are struck at current prices. And there's plenty of data on this space.
Okay, good.
Can I go back to your long-term picture, this long-term frame that you either market with? Because the reality yesterday was this message from Scott Bessent, the Treasury Secretary, talking about the fact that neither country wants to decouple.
Right.
All we've seen in recent years is decoupling.
Yeah.
Call it whatever you want, but everybody's been going in different directions. The US this way, the Chinese this way. Do you think that there is any truth to that nobody wants decoupling? Or do you see down the line just further moves to separate away from each other to be less reliant?
We in private markets, well, I can give you a personal view because I mentioned earlier that I'm based in Hong Kong. The reality is that trend of resilience and supply chain alternatives, if you call it decoupling, has been going on for a number of years and is very likely to continue. However, this is an unprecedented statement that we had not heard. And it's very much welcome, I think, on both sides, and very much welcome by the overall investment community overall. So I think all of the above, both can be true. You'll have the framework for the market to see the range of outcomes, as well as investment that will look for resilience and alternative and supply chain diversification.
Would you say China has suffered in recent years from that decoupling, that it has actually been unvestable because of the hands-off approach from the Americans?
I might surprise your listeners saying clearly no. I just flew from Hong Kong right before the Geneva weekend negotiations. The mood was not that, oh my God, we're suffering. Not at all. And so just for what it's worth, anecdotal on that. I think that if you go back to private markets, part of your question is correct in the context that a lot of the allocation to Chinese-based or even widely Asia-based allocation managers within global private market portfolios has been going down. I think that's part of where you're coming from. And that has started a few years ago and is likely to continue, actually.
I can see you've been invested in disruptive technologies, and I just want to get to that quickly because that goes to the heart of what we've seen in this decoupling, that the Americans are so concerned about the Chinese accelerating on technology and that eventually they'll get past the American edge one day. What do you see now that's worth investing in the Chinese market on the back of all that DeepSeek and Alibaba news from earlier this year?
Interestingly enough, AI has been much more investable in private markets in the US than it has been accessible in China. And therefore, you have to think of China as much more of a domestic consumption play for private market investing.
Juan, let me ask you about a story that's been brewing in the U.S., and it's a huge story around university endowments. Universities have been, locked up, as many sectors have been, with the Trump administration, and are now potentially in a situation where they have to look for research funding elsewhere, given the tension that's currently in play with the Trump administration. University endowments, big holders of private equity. Harvard is reportedly considering selling down some of its private equity holdings, and you've got Bill Ackman saying this could be a huge headache for private equity funds if we see other universities follow suit. Can you weigh in how worried PE should be about this?
Absolutely can. They've been long-term participants. They are known for the returns they've obtained, for their very high allocations to the asset class, to the illiquid asset class in the 50s or so. And from that point of view, it merits this conversation. However, you pull it back to the flows, to the size, they are not the largest allocators in dollar terms to the asset class globally. So there's a bit of a share of mind versus share of wallet. And so I'll take a red disagreement with Mr. Ackman on that point, that the industry is much bigger than the endowment market. to the context of the question on sales that Steve was mentioning earlier, this is not the first time they've sold. There's liquidity in private markets through the secondaries market that we talked about, and there have been portfolios, but it's not unprecedented in size, and they will manage it well because again, you choose the timing of the exit, and the market has typically high quality portfolios to look forward to.
We had a great guest yesterday where we were talking about the process of de-equitization as well, i.e. the fact is there's a lot less companies in the public pool than there have been. But they're a very important part of the whole ecosystem as well, and very often part of the exit route for the private sector as well. How does that relationship look to you at the moment between public and private sector? Does it look healthy, or actually is there something that policymakers, exchanges, the sellers of companies, they need to change in order to make the relationship better?
Well, I would say on the one hand, it's never really been the dominant exit route. It dominates the debate, but again, back to Hamilton Lane data, which we're happy to provide, it doesn't even get to 20% of the actual exit avenue.
Private to private
It's private to private, it's private secondaries, and the largest part of that pie is strategics. You sell in private equity to other corporates. I know that doesn't get enough coverage because it's kind of not transparent as much, and the headlines are, but that is the biggest buyer of private markets' own growth.
So take that board on board that point, but going back to the public markets, what is the problem there?
No, going back to the relationship in and of itself, I don't mean to leave your other question unanswered.
No, you go.
You have these changes globally asking for more companies to go public. This is like they can pitch you all day long. We private market asset owners get these changes and line up, send us more companies. More companies need to go public. That friction, the methods to go public, all of that, the size, the minimum size has been coming down, right? And it's a stage in the evolution of companies that is being part of the landscape. It's not as much the case in Asia as it has been out here, meaning that you still have more public companies growing. So the relationship is evolving. I go back to your question. Different structures can be actually made public, and there will be connectivity between being public and private in different ways. So I think everyone is trying to facilitate that, but it's not a panacea to the current liquidity crisis, perhaps, which is probably where you're going next.